the cash flow portfolio. How to turn your investments into a paycheck. Imagine checking your bank account on the first day of every month and seeing a deposit that has nothing to do with a paycheck. Not because payday arrived, not because your employer sent your salary, but because your investments did. The rent gets paid, the groceries are covered, the electric bill disappears, and your portfolio keeps working whether you're at work, on vacation, or asleep. For most people, financial freedom is a number. $1 million, $2 million, maybe 5. Save that number, the thinking goes, and everything else takes care of itself. But here's the uncomfortable truth: $1 million sitting in an account doesn't pay your bills. Cash flow does. That's why some people retire comfortably with far less money than you'd expect, while others accumulate millions and still feel trapped. They built wealth. They never built income. Today, we're going to explore one of the most practical investing philosophies ever created, the cash flow portfolio. Not a strategy designed only to grow your wealth on paper, but one designed to turn your investments into a paycheck that arrives month after month. The biggest myth about retirement. Most people think retirement means one thing: a big number in a brokerage account. Save enough, invest it well, and hope it lasts 30 years. But that's only half the story. There are actually two completely different ways to live off a portfolio. The first is selling. You sell a small piece of your investments every month and use that money to live. Financial advisors even have a name for it. The withdrawal rate and the 4% rule is the classic version. Sell a little, let the rest keep growing, repeat for decades. It works, and historically it has worked for a very long time. But it requires something a lot of people struggle with: watching your balance shrink month after month and trusting the process anyway. The second approach is completely different. You don't sell anything. You keep every single share you own, and you live off the income it produces instead. Dividends, rent, interest, cash that shows up in your account without you ever selling a single share. Here's the part most people never stop to consider. Neither approach is universally better. It depends on your goals and it depends on your personality. Some people are perfectly comfortable selling shares for income, and mathematically, in many scenarios, it works out just as well. But for many others, watching their account balance shrink every single month feels stressful, even when the math says everything is fine. There's a psychological piece that comes from a portfolio that pays you without you ever touching the principal. You don't sell. You just get paid. The number in your account stays the same, or keeps growing, while cash lands in your bank account regardless. There's also a practical side to this, something researchers call sequence of returns risk. Selling shares during a market crash locks in a loss, forever. A bad few years right when you start withdrawing can permanently damage a portfolio built purely on selling. But collecting a dividend or a rent check during that same crash doesn't require selling anything at all. You simply get paid, market conditions aside. And that peace of mind is exactly why the cash flow portfolio exists. The 4 engines of cash flow. Before we talk about specific investments, let's talk about where cash flow actually comes from. There are 4 engines that power almost every income portfolio ever built. Engine 1, dividend growth companies. These are mature, profitable businesses, the kind of company that's been around for decades and no longer needs every dollar of profit to grow. So instead, they share it with shareholders through dividends, paid out every quarter like clockwork. The best ones don't just pay a dividend, they increase it every single year, sometimes for 25 years in a row, sometimes for 50. Think of the household names that sell you soda, soap, or medicine, the kind of companies people keep buying from in good years and bad. That reliability is exactly what makes their dividends so dependable. Engine 2, real estate. Real estate produces rent. That's nothing new. Landlords have collected rent for centuries. But buying a property requires huge amounts of capital, a down payment, a mortgage, tenants to manage. Real estate investment trusts change all of that. They let you access that same rental income through a single investment, bought in seconds from your phone. Shopping malls, apartment buildings, data centers, warehouses owned by thousands of investors at once. each collecting their share of the rent with no tenants, no repairs, and no mortgage of your own. Engine 3, covered calls. This one sounds complicated. It isn't. Covered call funds don't sell your shares. They sell part of the stock's future upside to someone else in exchange for immediate cash paid today. You give up some potential gains if the stock rockets higher, and in return, you collect income whether the stock goes up, down, or sideways. It's a trade-off. Less lottery ticket upside, much more consistent cash deposited every single month. Engine 4, Treasuries. The government borrows money and pays interest for borrowing it. Treasuries don't generate excitement, and nobody brags about owning them at a dinner party. But they generate something more valuable: stability, cash. You can count on even when everything else is falling, the kind of asset that lets you sleep at night no matter what the headlines say. 4 engines, different assets, different jobs, one objective: reliable cash flow, month after month, regardless of what the market is doing. So how do these 4 engines actually come together? Here's one example of a cash flow portfolio built with 5 positions instead of 1. 30% SCHD, the foundation of the portfolio. SCHD owns roughly 100 profitable companies that raise their payouts year after year. It won't make headlines, and it's not designed to. Its job is slow, steady, reliable growth in the income it produces. 20% JEPI. JEPI handles monthly income, generating consistent cash flow using a covered call strategy on U.S. large-cap stocks. It trades away some upside for a much smoother, more predictable payout, arriving every month instead of once a quarter. 10% JEPQ. JEPQ pushes that further, higher income, with more exposure to fast-moving technology companies, more potential reward, and a bit more volatility along with it. Together, JEPI and JEPQ act like the accelerator pedal of the portfolio. 20% VNQ. VNQ brings in real estate income, rent collected from hundreds of properties across the country without owning a single one yourself. 20% SGOV. SGOV provides stability and liquidity. Short-term government treasuries, ready to be used the moment you actually need cash. Now, I'm not going to tell you to buy this. That's not the point of this video. The point is understanding why each position is there, because each one solves a different problem. SCHD grows the income. JEPI and JEPQ accelerate it. VNQ diversifies it. SGOV protects it. Notice something. No single investment carries the entire portfolio. Each one has a responsibility, and together they create something no single asset could create alone. A steady, diversified paycheck, month after month. This is just one example, built with 5 funds. The exact percentages matter far less than the principle behind them. Balance growth, income, real estate, and safety. And you get a portfolio that can weather almost anything. A recession, a rate hike, a rough year for stocks or for real estate or for both at once, because the income was never resting on one single engine to begin with. What does this actually pay? Numbers make this real, so let's walk through a few conservative examples. Nothing exotic, nothing designed to impress you, just simple math using a 5% annual cash yield. A $250,000 portfolio generating around a 5% annual cash yield could produce roughly $12,500 per year, about $1,000 a month. That's not enough to replace a full-time salary for most people, but it could cover a mortgage, rent, or another major recurring expense every single month without selling anything. Double the portfolio to $500,000, and that same 5% yield becomes about $25,000 a year, around $2,000 a month. For some people, that's enough to create real financial flexibility or support a part-time lifestyle, working less while the portfolio fills the gap. At $1 million, a 5% cash yield would be approximately $50,000 per year, a little over $4,000 a month before taxes and expenses. Depending on where you live and how you spend, that could cover a significant portion of your living costs, or all of them. Keep in mind, these numbers ignore taxes. Holding this kind of portfolio inside a tax-advantaged account and where you live can change the math significantly. But remember this immediately. These are simplified examples. Yields change year to year and fund to fund. Markets change, and your income will fluctuate along with them. The objective was never chasing the biggest yield you can find. That's exactly how people end up in risky, unsustainable funds that eventually cut their payouts. It's creating sustainable income that lasts for decades, not months. Is this portfolio right for you? By now, you've seen 4 very different portfolios across this series: the growth portfolio, the modern diversified portfolio, the barbell portfolio, and now the cash flow portfolio. Each one solves a completely different problem. The growth portfolio maximizes long-term returns by simply owning the market. The modern portfolio balances risk across many different assets at once. The barbell portfolio protects most of your money while chasing outsized gains with a small slice of it. And the cash flow portfolio replaces your paycheck with income, whether or not the market cooperates. None of them is superior. There isn't a single best portfolio that works for everyone, no matter what any headline promises. There's only the one that matches what you actually need right now at this stage of your life. Are you still decades from retirement, mainly focused on growth? Do you need your investments to protect you more than they need to excite you? Or are you closer to the point where you want your money working for you every single month? Most people honestly end up needing a mix of more than one of these over the course of their lives. The question was never which portfolio performs best. It's which portfolio fits your life. And for a growing number of people, the answer is a portfolio that quietly pays them every single month, not because it's the highest performing option on paper, but because it lets them build a life around income they can count on. Recap. Today, we completed something bigger than a single portfolio. Over this series, we built the growth portfolio, designed for maximum appreciation. The modern diversified portfolio, designed for balance and resilience. The barbell portfolio, designed to survive uncertainty while embracing asymmetric opportunities. And now the cash flow portfolio, designed to pay you month after month, regardless of what the market is doing. But every piece of this portfolio deserves its own conversation. How does SCHD keep growing its dividends year after year? Why do JEPI and JEPQ generate such high monthly income? Are REITs really the best way to invest in real estate? And can someone actually retire on dividend income alone? Those are questions we'll answer in future videos, each one breaking down a single piece of these portfolios in depth. If you're building your own path toward financial freedom, subscribe and join us. Because here, we don't chase shortcuts, and we don't chase hype either. We build wealth one decision at a time. Remember, you don't have to pick a single portfolio and never change it. You simply have to understand what each one is built to do and choose the one that matches where you are right now. A little wealth built consistently can become financial freedom. I'll see you in the next one.